What is the difference between a conventional loan and an FHA loan? Today we're going to look at the two side by side, including projected interest rates, how much you need for a down payment, what kind of debt to income ratio you might have to qualify. It's not the most exciting information, but you absolutely need to know this to make sure you're getting the best possible deal as both a buyer or a seller. Let's get started. Hey everyone, welcome back to my channel. I'm Erica Monroe. I'm a realtor in the Bay Area and I specialize in Solano County. For our veteran and active military folks, please check out the video above. I spell out new guidelines and everything you need to know to take advantage of your VA benefit. But for today, we're going to look specifically at conventional loans versus FHA loans. The main difference between these loans is that one is backed and insured by the federal government, which is an FHA loan. It stands for Federal Housing Administration, versus a conventional loan, which is private lending. It's a private mortgage that doesn't have any direct backing by the government. Let's take a look at how this impacts qualifying for each type of loan, starting with credit score. For conventional loans, most lenders will require a minimum credit score of 620. The higher the credit score, the better candidate you appear to be, and that's going to be reflected in the interest rates that they quote you, as well as the overall purchase price. Now, just because you have a 620 or higher credit score doesn't necessarily mean that you're going to qualify for a conventional loan. FHA loans are a little more lenient. The credit score that you need to have is a minimum of 580. If you fall below this threshold, there's likely some work that you need to do on the back end regarding ensuring that you're making monthly payments on time or reducing your debt. The general rule of thumb for both loan types is that the higher your credit score, the less risky you are as a borrower, because remember, credit score shows a lender how responsible you are with your money. The higher the credit score generally means you're not late on payments, you're not missing payments, and you can manage your funds well. Let's take a look at down payment requirements. For a conventional loan, most buyers are required to place at least a 5% down payment. However, there are some new conventional loans that if you qualify, you're only required to pay a 3% down payment. You usually have to have an impressive credit score, really great income. It's perfect for folks who just have not saved up enough money to hit that 5% marker. These new conventional loans are often paired with a home buyer program. It's an 8-hour course that you'd have to take and pass a very straightforward phone interview. For FHA loans, the minimum down payment is 3.5%. And regardless of how much you put down, you're always going to have mortgage insurance. So what is a mortgage insurance premium? It's basically a set amount that the lender charges you annually, and it's broken up monthly and added to your mortgage payment. It's reassurance for them that if you default on your loan, if you stop paying your mortgage payment, that they'll be able to recoup their losses. It's insurance for the mortgage servicer. Now, conventional loans have a similar concept. It's called private mortgage insurance, but it's only applicable to buyers who place less than a 20% down payment. And once you're able to prove that you have 20% equity in your property, you can call up the lender and have them remove your mortgage insurance. You can't do that with an FHA loan. You have to actually physically refinance out of an FHA type loan into a conventional loan for that mortgage insurance to drop off. For FHA, you actually have two different types of mortgage insurance premiums. One is paid up front. It's 1.75% of your purchase price. It doesn't necessarily mean you have to have more cash up front. It's usually wrapped into the loan. And the other is similar to PMI, the conventional style, where it's an annual amount divided up monthly and added to your mortgage payment. The amount of mortgage insurance you're charged is going to depend on your qualifications as a buyer. So again, the higher the credit score, higher the income, lower the debt, the lower your mortgage insurance should be. I've seen it as low as $90 a month for a very well qualified candidate, and I've seen it as high as several $100s a month for a buyer who didn't appear to be the most ideal candidate on paper. Moving on to interest rates, which might actually surprise you. Conventional interest rates tend to be a little bit higher than FHA interest rates. How does that make sense? Conventional buyers have to be better qualified buyers. but FHA is federally backed and insured, so typically lenders can offer interest rates a little bit lower. For conventional loans today, I have buyers being quoted 5.875% for conventional loans, versus FHA is hovering around 5.5%. Debt to income ratio, which you've probably heard is DTI, is another factor in how a lender will qualify you for either a conventional or FHA loan. Each has a different threshold. So for DTI, they take your gross income before taxes and compare that to your monthly commitments. That includes housing expenses and any payment that basically falls on your credit report. So if you have a large car payment, that'll count against your debt. Any monthly minimum payment for credit cards will also count against your debt. For conventional loans, the maximum debt to income ratio usually hovers around 45%. Again, if you're an exceptional candidate, if you have really high credit scores, high income, you may be able to stretch that up to about 49%, but it's really a case-by-case basis. For FHA loans, generally the maximum debt to income ratio hovers closer to about 43%. Again, if you have factors that make you an excellent candidate, the lender can push that all the way up to about 57%. So you really won't know what your threshold is and what loan you would qualify for until you have that conversation with a lender. A few more key differences that you need to know. Most condos and common interest developments are going to require a conventional loan unless they're already pre-approved as an FHA approved development. There are a sprinkling of them in Solano County, but a majority will require a conventional loan. FHA appraisals are always more stringent than conventional appraisals. And I don't mean specifically about purchase price, because it's been my opinion that FHA appraisers will price homes very similarly to how a conventional appraiser will. However, FHA appraisers will look more closely at the condition of property as well as health and safety measures. So for example, if there's excessive peeling paint on the exterior, there's visible dry rot or termite damage, there's a roof leak or the roof is clearly in need of repair, an appraiser is likely to call that out as a condition. So something that has to be cured or repaired prior to closing. So for a seller, depending on the market, and right now we're a cooler market than we were 2 years ago, I definitely encourage you to take care of these items before coming to market so that you entice more buyers, but also you avoid delays and potentially a buyer backing out before closing. Whether you qualify for a conventional or FHA loan, if it provides you the opportunity to purchase the home of your dreams, it really doesn't matter. You'll have equal opportunity in either arena to refinance in the future. Thanks so much for watching. Please reach out to me for any specific questions or if you'd like some lender referrals.